Good morning. I have exactly 10:30, so I'm hopeful this won't be the first or the last time, but it'll definitely be the first time that everything gets started on time here, right? So I'm Andrea Belfanti. I'm the CEO of the International Society of Hospitality Consultants. We have an amazing panel here, and we've got a lot of information to cover, so we're going to jump right in. For those of you in the back, there are plenty of seats in the front row. No? Shocking. Yeah, really nice seats up here. Some nice people. There's some students here from Kennesaw State. You can sit by them. All right. So there's some handouts being passed around or that were passed around that have lots of acronyms on them. If you didn't get one, you are welcome to write handout on a business card and hand it to me after, and I'll email it to you. Or we'll try to get it on the app. I'm not sure if that'll happen. So I'm going to start with introductions, and then we'll jump in. Kendra, I'm going to start with you. Tell us a little bit about yourself, what you do, and then we'll head down the line.
Sounds good. Good morning, everyone. My name is Kendra Plummer. I'm the founder of Elise Capital, which is a hotel investment and advisory firm. So currently we are building our portfolio, acquiring more hotels, and helping future hotel owners along the way.
Great. Jonathan?
Good morning, everybody. Jonathan Jager. I'm with LW Hospitality Advisors in New York. We are a valuation and advisory services firm. Our services include valuation appraisals, market studies, feasibility studies, asset management, litigation support, and also we have a predictive analytics platform, some of you may know, called LARC, Lodging Analytics Research and Consulting.
All right, Amanda?
Good morning. I am Amanda Shivers, the Managing Principal of Crown Hospitality Consulting based here in Atlanta. We are a boutique hotel asset management firm that focuses primarily on hotel asset management, construction oversight and development, strategic planning as well. Most of our clients are private equity guys who want to invest their money in funds and stay focused on their stakeholders, and so they tend to hire us to oversee those assets and grow the value of those assets on their behalf.
Great. Rick?
Good morning. I'm Rick Pastorino. I'm the senior citizen on the panel this morning. That's why I'm sitting closest to the screen so I could see it. RevPAR International, we've been around for 32 years, 92. We do asset management and advisory work based out of Washington, D.C. We cover the U.S. and the Caribbean.
And I'm very excited to say that all of these folks are members of ISHC. There you go. So, all right, we're going to start with a little pop quiz. And actually, I'm going to need to grab my glasses here. So total number of global hotel rooms. How many of you think it's 10.5 million rooms? Raise your hand. All right. 17.5? Raise your hand. All right, a couple hands. And the last number there. How many of you think it's that one? All right, some of you didn't vote, but that's okay. All right, the answer is...
It's early.
17.5 million. Good job, guys. So lodging industry, some really interesting facts here. I'm not going to read it all. I think it's an extremely impressive industry. When you look, the global hospitality industry is worth over $3.95 trillion as of 2021, which is pretty amazing. So setting the stage, all right, Rick, tell us a little bit about how the hotel space is different from other real estate classes.
Sure. So this is really one of my favorite slides that sort of captures the difference between hospitality real estate and all the other real estate classes. You'll see on the left-hand side, it's both an operating entity and real estate. A lot of people entering our industry view it as real estate and miss the part that it is truly an operating entity. Any management company in here knows that. And depending on where we are in the cycle, there's more weight given to one versus the other. So you need to know, and there's several slides on the cycle in here, so we'll talk about that later. The reason why it's an operating entity is because you have to rent that room every night. It's not like an office building, multifamily, or industrial where you are leasing it for multi-years so that you avoid some of the economic cycles that hit the whole hotel industry. People can cancel that reservation on a moment's notice and you're left with an empty hotel. Capital intensive, you can't deliver 5 rooms at a time. You need to build the entire hotel, irrespective of whether or not you think you're going to be able to fill it. And it's still labor intensive. We're moving away, trying to, through technology. However, anywhere between 40 and 60% of your expenses are still tied to labor and benefits within a hotel. It's a maturing industry, and the last one's cyclical. We're going to talk about that later.
Do you want to go to your next slide?
So this shows the returns over an extended period of time. What you will notice, given that we're the highest risk of all real estate classes, you'll notice that the returns fluctuate abnormally here, and we're typically coming out on the bottom in this particular graph relative to our counterparts in the other commercial real estate sector. So you need to be astute, you need to know what you're doing, you need professional management and so on if you want to make a return in this industry, and I think this graph sums that up very well.
So Rick, when I put this slide up, I saw some people leave. Do you think they're just giving up on real estate altogether? They're just like, okay, we're done. All right, so sources of equity. Speaking of money, estimates indicate that hotel sources of investment capital are similar ratios for the other real estate classes that Rick just mentioned, with private equity accounting for 75–80% and public equity accounting for the 20 to 25%. So Kendra, I'm going to go to you next. This slide is pretty basic. Can you give us a little more detail on where the money actually comes from? A little bit about debt, equity, private, public. Help us understand this.
Sure. So hotels are leveraged assets, just meaning that there's a mix of both equity and debt whenever you're doing your deal typically. So on the equity side, you can have 2 sources of equity, which would be in the categories of public and private. On your public side, these are typically real estate investment trusts. They're open market where you're buying shares into these assets. So these are companies such as RLJ Lodging, for example. On the private side, these are funds or individuals who are directly investing into the hotel. And this is typically where most people would be getting their equity from. This is anywhere from the institutional investors, where your high net worth individuals, family offices, private equity firms, to your non-institutional, which would be tapping into your networks of your friends and family and being able to invest directly in the deal. So on the private side, it is a little bit more exclusive to get into because you do have to have that relationship into it. But once you are on that private side, then you have more opportunity for how you want your hotel direction to go. And then on the other hand, with the debt side, public would be considered your commercial mortgage-backed securities, or CMBS. So this is a loan where once the mortgage is taken in and assumed, it's then rolled into bonds and into a portfolio and a trust. So these are then serviced by your companies like Goldman Sachs, Morgan Stanley. This is typically where you can find those CMBS. On the CMBS side, usually the underwriting can be a little bit more favorable or flexible to the hotel side. But then on the other hand, you don't always have a direct person to be speaking to. On the private debt side, these are your commercial banks, the pension funds, as it says there as well. Commercial banks like your regional banks, your community banks, industrial bank, for example, would be one where they are able to take out commercial loans, and you then have a relationship for the entirety of your deal and your asset.
Great. So I see there's a lot of people coming in. There are seats up front, and all joking aside, if you guys want to come up, don't worry about it. We've got a couple seats over here, 3 seats up here. Come on up. We've got some more students. There you go. Bring in the students right up front. Okay. So, Jonathan, I'm going to go to you next. There are a lot of different people that are going to be at this conference. Lots of different types of people representing different types of companies. They play different roles in the industry. Walk us through a little bit about who all those people are. And what I find really fascinating is everyone on this slide and everyone here, except for maybe the students, but that's only short term, are here to make money. right? But
Yes.
you're here to make money at some point. So how do we figure out, how do they all get paid?
I think we should add students to the slide.
Yes,
for
I like
next
it.
time, just so everyone's included.
Let's do it.
Maybe just a quick show of hands. I see a lot of familiar faces in the room. I know some people are maybe new to the industry. How many people in the room have been involved in either building a hotel, buying a hotel, or lending on a hotel? Okay,
That's a good number.
maybe about half the room.
So
Okay.
this is a refresher course.
Yes, yes. So we've got an educated group here, but essentially, this is the hotel investment ecosystem from a 30,000-foot view. As Andrea was saying, it's kind of bringing together everyone, and that's what's great about these conferences, right? It brings us all together in one place to talk about what we're doing and learn about what's happening in the industry. So something Rick mentioned before, and I think is important to highlight, that hotels are extremely complex pieces of real estate, right? It's the real estate and the operating business brought together. That means that you don't have credit tenancies. You don't have an industrial lease for multiple years. You don't have an office lease. We used to think of office leases as safe, maybe not so much anymore. But the complexity, right, is what brings to the ecosystem the need for all these different players and all these different parties. And so what Kendra was talking about and Amanda with who the owners are, who are the equity investors that are putting money into deals, that's in the green part. And then we have all the advisors like we are, helping the owners make informed decisions, find the right deals, determine feasibility, valuation for the projects. We don't actually get a key part in the slide here, but we're off to the side, which is okay. And then down below you have the asset managers. Some firms, right, will do in-house asset management, have their own teams internally. Others will hire third party, like those of us on the panel here, to help them make informed decisions. And then you go to the next layer, which is having finding the right brand or the right operator. Brands also operate, right? So do you want a brand managed hotel, or do you want to franchise your hotel and bring in a third party operator? These are all decisions that can have a massive, massive impact on your bottom line and ultimately your exit value. And then going down, we talked about the brands. Do you even need a brand, right? Independent hotels, and especially as we look in Europe, are much more common than they are in the US. The US is definitely more branded hotels, but where's your demand coming from? Does the demand want a brand, and get the points of the Marriott, Hiltons, and the Hyatts and the IHGs? Or is that not important? Are they coming to your hotel because of your location or what you're offering or your food and beverage offerings, et cetera? So again, very high level, but a lot of things to consider when you're looking at the ecosystem of hotels. And then last but not least, obviously we can't forget about the guests, right? The guests that are staying at the hotel, that are driving travel, both business and leisure, and on a group side throughout the country.
Great.
Andrea, I may point out that all the professors in the audience,
Yeah.
this would be a great slide for them to use in one of their tests.
Yeah, like I said, I'm happy to send me an email and I will send you all the deck. All right, so Jonathan, you alluded to this, the number of brands. So another pop quiz. How many of you think, this is globally, STR lists these brands globally. How many of you think it's over 250? All right, we've got a few hands. All right, over 500. A few more, over 1,000. Again, a lot of you aren't answering. Ashley, they don't get credit then, right? They do not. All right, the answer is over 1,000. In fact, there are STR lists over 350 for the US alone. So a lot of brands out there. So Jonathan, thank you for spoiling my slide. Right here,
I didn't
the
give away
US.
the numbers.
All right,
I
okay.
saved the numbers, yeah.
So we're talking about the US here, but I think it's really interesting that in the US, over 70% of the hotels are branded, 30% independent, and it's completely the opposite outside of the US. So Rick, I want you to talk to us a little bit about brands. Give us the high-level summary of why someone would brand, what it costs, why do you pick a brand, and how do you pick a brand?
Okay, well, that's a lot.
It's a lot. I know. And if you could do it in like 45 seconds, that'd be great.
I would say the reason why people, developers, owners choose brands is because they want access. Access is the key word, access to a customer base, access to standards. People are looking, when they're choosing hotels, many times they're looking for familiarity with the experience that they want, and brands provide that, and they're spending a lot of money out there to entice consumers to use their particular brand. So you're really buying in, we call it the pipe. I mean, you're buying the pipe when you brand your hotel. They deliver customers. And I think the second thing, we always talk about the three types of risks in hotels. There's management risk, market risk, and financial risk. And branding mitigates all three of those, particularly from a lender's perspective, because when you go in to ask for debt on your hotel, the lender has a series of boxes that they're checking to estimate what the relative risk is to the debt that they're going to put on this hotel, and branding is high up on that list, and they want to be able to check that box because it makes it easier for them when they go to committee to get approval on it. But it really does spread from market risk. If you're in any location and you're able to distinguish yourselves through branding, that helps mitigate the risk because you're tapping into that consumer base. From a financial perspective, it is providing you access to technology and to a brain trust of what the brands have already developed internally, and they are willing to share with you for a price. You're paying for it, but there's access there. And then on the management side, as Jonathan mentioned before, you can either ask the brand to manage it for you, or you can use a third-party manager, but the brands are providing a platform of technology, standards, purchasing ability through their platform that allows you to execute whatever you're trying to do within that box, hopefully at a lower cost. Again, you're paying for it, but the offset is that they're providing you that access so you don't have to go out and try and create it or do it yourselves. So collectively, I think there's a slide coming up. Oh, here it is right here. So collectively, when you add up all the costs of a brand, I think this came out to 10.2%. We've seen it range depending on the brand and where we are in terms of time. Evolution, it's going to range anywhere from 10 to 14% of cost of rooms revenue for you to obtain that license from any of the major brands. Some of them are on the lower end, some of them are on the higher end, but generally that's where you're going to be looking in terms of a cost.
Great. So Amanda, many of you might be thinking, why hasn't Amanda spoken yet? Because we've saved a big one for you. We're going to talk about the real estate cycle. And I've got a couple slides here. Tell us how it works. We're going to hear a lot in the next couple of days about, are we in a recession? Is the recession coming? How is it going to affect us? So help us understand what all that's going to mean.
Sure. Well, I actually love this slide in particular. If you're going to invest in real estate, really any type of real estate, you have to be aware that there is a cycle in the investments. And so there's four phases of that cycle, and you typically start out, if you're at the top where there's expansion, that's typically when everything is booming and everyone's making money. That phrase, well, when the waters rise, all ships rise. That's an expansion where you're seeing cranes in all of the cities and the rates are going higher and higher, which brings more people into development because they see the plethora of activity and they see the profits. That's typically what we have during an expansion period. And then, of course, as we get overdeveloped and there's a lot more supply that comes into the marketplace, you'll start to feel that pressure and the pricing will subside to a bit. Or other things can happen, like a black swan event or something that causes us to go into a recession in which the rates decline or the demand for your product declines. Obviously, we just recently came out of that with COVID, and you can go into a recessionary period in which it's slow. You'll find that it's harder to get financing during those depressed times of economic recovery. Your lenders are going to be a little more hesitant to place that loan on a hotel, particularly for new development as well. And then as we come out of the recession, we will start to come into a recovery period. And I know I'll go ahead and jump into it because everybody wants to know where we are right now. And so I personally believe we're in a recovery period, although it's an unusual recovery period. So we obviously had, the COVID pandemic, which happened in 2020. We saw what happened to the hotel industry globally. what we also saw is that demand came back ferociously. There was a lot of pent-up demand because people could not go anywhere and could not travel. So we have seen tremendous recovery in the hotel industry. We've seen rates return. We've seen occupancy return. If you've purchased an airline ticket recently, you can see that it's really hard to get a flight, and the prices of these flights are crazy, and the prices of the hotels are crazy too, right? So we are definitely in a strong recovery period. However, because of the Fed policies in which there's been a lot of stimulus money that was pumped into the economy over the last 2 years, that has driven up a lot of the pricing and a lot of the demand, and there's worry or concern or questions, uncertainty, whatever word you want to pick, as to what that demand is going to look like going forward. And also there's questions about the stability of the consumer, which are the people that actually stay in our hotels, right? So as they were originally flush with stimulus cash, and they have burned through a lot of that stimulus cash, and we're starting to see that there's a lot of questions about debt incurring and how strong is the consumer. Well, when you look at that upward trajectory coming out of the recovery and going back into another boom period, that is going to be largely dependent upon two things: the demand, which is the strength of the consumer, the people who are staying in our hotels, and number two, the ability of our markets to be able to get access to cash and capital to either continue to develop and operate hotels. That's saying a lot, but that's where we are. And so over the next 6 months to 12 months, those things will shake out. I honestly think that this is going to shake out sooner rather than later, and maybe I'm just optimistic. But I think we've seen a lot of the supply chain issues kind of subside. We're starting to see some of the pricing begin to subside, even a little bit on the labor. Maybe, again, I'm being optimistic, but I think we're coming out of the recovery pretty strong. And over the next 6 months to 12 months, we could have a full recovery. It just depends on what happens with the Fed and the markets.
Andrea, can I just say?
Sure.
I think when you look at this chart, it's a street corner business at the end of the day. So this is sort of that national or global cycle. But if you're in a particular market, you may be a different place. And I think the best examples coming out of the pandemic that we've seen in the work that we're doing is resort markets recovered very quickly as a result of what was going on with the pandemic and the search for outdoor recreation activity. However, urban markets did not. They languished until much later in the pandemic. So when you're looking at certain markets, you may be at a different point in a resort market on this cycle versus an urban market that's probably has a lot more room for recovery over the next couple of years.
Yep. Great point. Amanda, do you want to talk through this slide?
Yes, so this slide is basically showing the magnitude of the pandemic that we are coming out of. So you can see, and as someone else has already said, the risk of operating and running a hotel is that it's a daily concern. So you have business that you have in rooms that you have to rent, lease every single day. It is not an office product. It is not an industrial product where you have long-term leases and they pay on those leases, regardless of what's happening in their marketplace. If you have a hotel and a global pandemic, which doesn't happen every day, occurs, or if you have something that happens locally, to your point, you have a beach hotel in a resort location and then there's red tide that comes through, right? I mean, anything can happen that can overnight impact your demand and your market, right? Or we know weather conditions, which have happened across the country, around the globe, really, right? So what this is really showing you is the decline, precipitous decline that we saw literally globally due to the pandemic. However, you can see that year-over-year percent change as well, how precipitous that climb has been, which we just alluded to. So are we going to continue to see that type of demand going forward? I think it's a possibility that we can see, again, strong demand 2023, 2024. Everyone's anticipating in the forecast that it's going to come back pretty strong. I think the big part is, again, the macroeconomics and how it impacts the consumers and whether or not they'll be able to withstand some of this impact from inflation. Obviously, the cost of expenses, how long will the consumer be able to continue to invest in travel?
I think the other thing this slide shows compared to the real estate slide that we just saw is the ups and downs, right? So we can see the Great Recession on there, we can see September 11th on there, we can see how these things really, that this can almost mirror what's happening with the real estate cycle on there. All right, I'm gonna pause for questions because we're about to get deep. So wake up, ask a question. We've covered a lot. No one has any questions on what we've covered so far? You're just really excited to keep going? Joe, you have a question?
In the 10 to 12% of costs for the franchise, is the res system included in that?
So let me repeat the question. In the 10 to 12% costs of going to a brand, is the reservation system included?
Yes.
Yes. All right. That was a softball from Joe. Thank you. All right. Jonathan, you're up. Your goal is to tell us about cap rates, what they are, how you get it, and to keep everyone awake. On your market, set, go.
Well, since I got the short straw here,
Yep.
Everyone's favorite topic, cap rates. So I'll say, by definition, a cap rate is very clear, right? It's the income divided by the value, right? And that's how you calculate a cap rate. However, I would argue, and this is open for debate, that cap rates are extremely ambiguous in our industry, right? How many people have been on the phone, oh, what's the cap rate on that deal? Where are cap rates today? What do you think about cap rates, right? We have these conversations every day. And the follow-up question needs to be, right, what cap rate are we talking about, right? So if we say a hotel sold at an 8 cap, what does that mean, right? Does that mean that the last 12 months, that's where the income was that was divided by the sale price? Was it 2019 income, right, which is what a lot of us have used really up until 2022 when we had a relatively normal year in some markets, not all markets. And so now, more so than ever, coming out of the pandemic, you really need to define what income you're using. And is it a direct cap? So this is direct cap, which is a 1-year snapshot of income. Everything we've talked about so far is telling you that hotels are extremely risky and they have the exact opposite of steady income, right? Your income might be X 1 year, and it could be literally 100% or more different the next year, something we all learned during COVID that I don't know if we thought was possible. So if we can go to the next slide. Just to give you an example and bring some kind of current events to it, right? I think what we're seeing now, like we always have, is this bid-ask spread in deals. So just a quick example, very simple. If you have a hotel that's got $1 million in income at a 10 cap, that's a $10 million selling price. But if the seller says, I want 12.5, well, you have to change, right, what you're solving for, and that cap rate becomes an 8. So you have a 200 basis point spread there. Basis points, basically 100 basis points is 1%, 200 basis points, 2%. This is what's creating a lot of the question marks that we're seeing in the industry now, a lot of the uncertainty, right? Because as interest rates go up, and we won't get into how you calculate or what actually goes into a cap rate so much, but interest rates, right? It comes down to the cost of capital, the equity capital and the debt capital. And now that the debt capital has gone up so much in the last 6 to 8 months, given what's happening with the Fed interest rates, it's changing the dynamic of what cap rates are. And so I think this is a very hot topic, something we'll probably hear a lot about here at the conference, and why transaction volume has frankly slowed down quite a bit after kind of middle of last year and 2021, which were great transaction years, a lot of activity in the market. So we can go to the next slide. I wanted to talk a little bit about yield capitalization, right? Because I think this is the primary method we use to value hotels in the industry today, in that we're looking at multiple years of income. And so because what a hotel is doing today might not be what it does in the future, we're looking at multiple years, and then we're assuming a hold period. That could be a 3-year hold, a 5-year hold, a 10-year hold, and you project income over that time, and then you cap the reversion year, the last year's income, right? And that's what you're assuming a sale in the future, and then you discount it all back to present value. So I wanted you to see, and I can't see the numbers well enough from here to actually call them out.
Do you want to borrow my glasses?
Do you want to switch?
Yeah, please. Yeah, please. You can see the difference, right? So what I said here was an 11% discount rate and a 9% terminal or reversionary cap rate. And so that value in the middle is kind of the base point, right? And I wanted everyone to see, if you can see these numbers on the screen, what happens when you increase each rate, both the exit rate and the discount rate, by 25 basis points. You can see what happens to value as the rate goes up, right? The risk goes up, the value goes down. And so you can see, I just wanted you to get a sense for how these rates can impact this was probably a typical, Hampton Inn type hotel, for you to see what those numbers look like. And then the last slide we have on cap rates, and following up on what Amanda was saying before about the cycle and where are we today, my comment or my thought on this today is that we're completely off the chart, right? Because what's happening, and as Amanda correctly pointed out, right, ADR and occupancies are recovering, right? ADRs are stronger than they've ever been, even coming out of the pandemic. But what's happening is the recovery in the top line and the RevPAR is there, but we're going the opposite way into a recession in the financial markets. So I don't know if there's really a place for that on this chart, except that we're somewhere in between the peak and the recession, which is kind of the whole chart anyway. So the short answer is I don't know where we are.
So let's pause there. Rick, where do you think we are?
It's tough to say. I wasn't going to go there. I was, again, similar to the cycle, you need to know who your audience is when you're talking to them about cap rates, because different entities, private equity versus public REIT, are borrowing and requiring different rates of returns, which influence the cap rate that they're willing to pay for an asset. Because, again, what Jonathan said was cap rates are comprised of two components. It's the debt times the amount of debt, percentage of debt, and the equity times whatever your required yield is. So know who your audience is, because what we're talking about is sort of market rates that blend all of that together. There are secondary sources out there that you can look at that tell you all these different participants, what their requirements are for equity returns that influence the cap rates that they're willing to pay for it. Right now, I mean, the reason why there's a bunch of brokers in the audience here that we've all worked with for a long time, there's hush in terms of the number of transactions right now, because the market is sort of in disarray with the amount of increase that we've seen in the debt markets. I think Mike Lipson from Access Capital Financial pointed out last time when we were here last year, he says, well, you just have to, you're paying for the money, the debt right now, whereas before you weren't. It was relatively cheap. So I think we need to sort of get used to this new environment, and people are doing that right now before they actively start to transact again.
Great. Kendra, do you have a thought on where we are in the cycle?
No, it really depends on each deal. Each market is going to be operating in its own way. So in some of those markets that were smaller markets, maybe not your central business districts that didn't have as much of loss in 2020, they can be on the expansion side at this point. They are recovered pretty quickly, and they're now looking to grow. On the other hand, for those higher concentrated areas, I would say they likely are more so in the recovery piece, and that they're trying to get back now everything that they lost over the last 18 months or so before stabilizing and then further growing and expanding.
Great. All right, I'm going to pause again. Any questions? Cap rates, real estate cycles? You guys are still just so excited for more. Is that it? All right.
There's a question.
Oh, wait, we've got one? Sorry, go ahead.
I would love to hear thoughts, opinions as to London and futures get even tougher, or if it's going to relax a bit.
Okay, so I'll repeat the question and tell me if I've got it right. I'd love to hear your opinions on lending in futures to see if it's going to get any tougher.
Yeah.
Or if it's
London for hotel investment.
okay, overall lending for hotel investment.
For the next 6 months, 12 months, generally speaking, just
Let's say 12.
Let's say
12
12.
months. Yeah, I think, again, my personal opinion is that this is going to shake out. A lot of this is because of the Fed policies that are in place right now. And, you know, we're starting, even the Fed, you know, they come out and they're trying to assess themselves whether or not to continue to raise interest rates or pull back. They're taking the data in every week as far as, you know, employment numbers, as far as, inflation numbers. What I suspect is that they are going to be forced into a bit of a pullback just because we're already starting to see the impact that it's having on the overall economy. And that's probably me being optimistic again, but I think it's also about being realistic too. It's hard to manipulate the market, and I think they were trying to obviously cool off the inflation piece. They were trying to impact the labor market, bring down labor prices, but as they start to see that the inflation numbers are going down, they are in a catch-22. Why keep pushing forward with interest rates, right? So I think it's going to slow, in my opinion.
Anybody think differently?
Well, we have an inverted yield curve right now, which means the short-term rates are higher than long-term rates. So that tells you that there's disparity in the market of typically what you want to see, which is the other way around. The longer term, the higher the rate. I think 6 months ago, everybody was waiting for the second half of this year, thinking that it was going to take that much time for the Fed and the market to sort of understand whether or not we're stabilizing in terms of inflationary pressures, or is the Fed going to be required to continue to raise interest rates? If you keep your eye on the spreads, we've made reference to the spreads, because the spreads widen when there's large uncertainty, and they start to contract when lenders and investors start to feel more certain about the direction of the economy. So right now, the spreads are relatively wide. And if once you start to see those tighten up a little bit, that's telling you that the market is starting to feel that there is some stability on a go-forward basis, 6 months, 12 months out, and that would be a good indication of transaction activity starting to pick up.
I was going to say, I think it's very mixed right now, right? Because we deal with lenders every single day, and a lot of them are out there trying to lend. There's plenty of capital, their funds are strong. It's just more expensive to the borrower, right? And the borrowers are trying to understand that and see how that impacts their returns on the equity side. But I think we have to mention what's been happening in the banking industry, right? If you remember Q3, Q4, and I'm thinking we probably should have seen the writing on the wall a little bit better back then. A lot of the big banks, Bank of America's, the Wells Fargo's, the Morgan Stanley's, right, stopped lending or started to pull back a little bit, right? Because they wanted to shore up their balance sheet. Why? They probably saw what was coming, right? They needed cash, they needed liquidity. And so maybe they weren't lending as much on commercial real estate, including hotels. And so now with what we're seeing with SVB, Signature Bank, and some of the other banks out there, I think banks are going to be, in the short term, a little more cautious about putting out money because they need that for their balance sheet. But there's plenty of other types of lenders besides banks, right? And so they're the ones that I think will be more active in the next 3 to 6 months until banking stabilizes.
Great.
We have one more.
We got a question? Yes.
Trying to pin you down a little bit more specifically.
Whoa.
The range of cap rates today, as you're doing appraisals from say luxury to select service, where are we today versus where we were maybe a year ago?
Oof, that's a tough one. Because are we talking about full service, urban, 80s types hotels? We're talking about resorts.
That's what I'm saying. The range, though, those are usually the lowest cap rates, and select service are the highest, right?
Yeah.
So what is
Well,
the range today?
it depends though, because not to skirt your question, but it's a tough question, right? Because take a brand new Residence Inn in a semi-urban developing market, right? And that could trade at a much lower cap rate than a full service, upper upscale or luxury hotel. But I think generally what we're modeling, right, on a 5 or 10 year hold is that rates are up about maybe 50 to 100, maybe 150 basis points. Again, very general, and I gave you kind of a big range there. But that, I think, reflects accurately the higher cost of debt capital and the assumption that we're all optimists in the hotel industry, right? And so we assume that things will stabilize. So owners I know that are refining or acquiring hotels and getting debt today are assuming in a couple years they could refi at a lower rate. So that increase takes into account the entire hold.
So last year they were roughly 6 to 7.5% cap rates. Now they're 7.5 to 9.
on an in-place basis. I would say generally that's reasonable. I don't know what anyone else thinks on the panel.
I think you can just take the debt component of your cap rate and just multiply it by the new interest rate that you're paying. So if you were paying 4 before and now you're paying 6 or 7 now, and you're 60% leveraged, you can just do the calculation. I'm not sure whether or not the equity yields have changed. Again, it depends on who you're talking to, your audience of private equity versus public equity. But that's just a quick way to test how much the cap rates should be increasing if you're active right now.
Great. All right, I'm going to keep moving. So Kendra, we've talked about a lot. We've got a nice foundation. Let's say you're looking at a deal. Somebody brings you a deal. What are the top, let's say, 3 factors you look at? What are you looking at to decide if it's a good deal or a bad deal? How are you making these decisions? It's not just gut, right?
No, you should just go. Just
Yeah,
kidding.
just
Don't
go.
do that. So for, I guess first we would have to define what a good deal is versus what a bad deal is. So everyone, whether it's your PE firms, you as an individual, investing in a hotel, you should have your reason. Why are you investing? What is your investing goal? What is the return on investment that you're looking for? So if you're looking to have a high yield deal with high equity multiples and things of that sort, just considering the debt and interest rate climbs that we just spoke on, you're going to come across a lot of bad deals before finding a good deal. Whereas if your goal is just to have the pure joy of owning a hotel, there's a lot of good deals out there for you. So when it comes to that, how do you define or figure out what that ROI is going to be is through your underwriting, it's through your feasibility and understanding what you're investing in. So the first thing that we want to look at is a market analysis. What is the demand in this area? Is it demand that can go and leave? Is it demand that is pretty stable? Is there only one demand generator that we're relying on? Or is it a diverse market where even if one industry is down, others are still up and you're not completely losing your occupancy and your rate? On the other hand, from demand also comes with supply. So who are your competitors in the market? Are there a lot of other same types of brands? We just said there's over 1,000 brands out there. So are you competing directly with your same brand? What's really in this area? And how has your market recovered? So especially right now with a lot of the lenders are lending, but they're lending to deals that have shown signs of recovery and are going into expansion. So for your competitors, for your RevPAR in this area, how is that increasing and trending since the last few cycles that we've been through? So that's your first thing there is defining the market. The second piece that I would be looking at is the history of the hotel, your operations, who's the operator here? How has that operator been performing? Is there room for upside? Has there been cash flows in the past few years? And what do you as an operator or owner expect to be able to bring to this hotel to get to that expansion point so that when you're riding these cycles that Amanda just spoke on, that you're coming to the peak of the cycle at the same time that your hotel is reaching its peak and you've been able to grow it. That way you can exit at a healthier cap rate and then drive your return on investment. So in a lot of cases, whether it's an acquisition or a development, knowing the history or comparable history is going to be something that you'll be basing your forecasts off of and really coming up with your plan. Do you need a property improvement plan, a renovation, all of these types of things to determine your classification of the asset and how you can bring it to its highest worth. Which then leads you to your last part, which is being able to define that capital stack, a returns analysis, being able to see of the interest rates currently, how does that affect my cash yield? Interest rates are rising, but debt service coverage ratios and debt yields, those requirements are staying the same. So how do we make sure that our hotel is bringing through enough cash flows to be able to be approved by the lender, but also be able to have the correct cash flows that we're looking for in terms of our deal thesis, whether that's a 10% cash on cash return or an 8% if maybe you're a more stabilized private equity group. So being able to have, back to your three things, the market analysis, the operational history, and then your return on investment potential flows from all of those. And that's what you'd be looking for to determine if it's good or if it's a bad deal based on your investment goals.
Amazing. You get that the one that doesn't do this every day is the one asking the questions. And I'm sure they're like, good or bad? Come on, Andrea. All right, so Amanda, so we found Kendra's good deal, and we've got it. And she's like, this is the deal. This is going to make you some money. I'm all in. Tell us how you put together that deal, the capital stack that Kendra mentioned. Who are these players? How do they all make money? How does it work?
Well, again, as we've been discussing, this is the question that we're all asking, especially today, right? I mean, typically, in a normal environment, you would have to put forth some level of equity, somewhere in the range, 30, 40% equity, and typically you can get, in a normal environment, 60, sometimes even as close to 70% loan to value. So they take the overall value of your asset, and then they size the loan based off of the value of that asset. As she mentioned, your debt service coverage, they take the cash flow from that asset and they make sure that obviously the loan size and the coverage from that cash flow is going to be able to cover the debt service. If it doesn't, they typically, at like a development deal, they'll ask for you to set aside a reserve. This, again, is such an unusual marketplace that we're in, and then there's different types of capital again. The private equity guys, at least that I work with, they're typically looking for returns that are 20 plus IRR, which again, really hard to find in these environments. And then, you've got some of the more public sources. They are not as aggressive in their investments. So it depends, again, as Rick said, who are you going to for your capital and what is their requirement? And I think this is the perfect environment for you guys to be in today here at this conference when you talk to these lenders. What you really want to ask is, what is your investment amount? Like, what's your sweet spot? How much dollar-wise are you looking to deploy? And what is your return? And what markets are you looking to invest in? Like, ask very specific questions, because what you're trying to do is line up your deal. If it's a good deal in a market that they're interested in, then you want to know what you have to model or underwrite in your deal in order for them to look at your deal and say, okay, yes. Ultimately, you just want a yes. And you don't need it from everybody. You just need it from a few sources, right? So if you've got your equity lined up, make sure you've got additional equity, because again, they're probably going to come in a little bit lower because they're trying to mitigate their risk again, right? So make sure that you've got closer to that, 35, 40% equity. You also, in a normal market, you could have, a mezz piece that you could also layer in there, which is typically just a little higher as far as their return, because they're in a first loss position. So if something happens to your asset and it doesn't perform in the way that you anticipated it would, that mezz piece could be out of the money, as we call it. So when the value of your hotel or the cash flows of your hotel do not equate to the original value that you had when you acquired it and they made the loan on it, that mezz piece is going to be out of the money and they could potentially lose their money. So you're going to pay more for that debt as far as the capital stack. But again, I think if I were approaching a deal and I had a deal in my pocket and I were here at this conference, I would say talk to lenders that you know are interested in your market, number one, right? And then start asking them, where do you size your deals and what is your return? And then actually plug that into your model. And we typically do a little sensitivity analysis as well. I mean, obviously, with everything that's happening in the markets, the debt markets, I would, as you said, add another 100 to 150 basis points to that and play with the sensitivities there. And then ask them, if you have a little more equity, or if you have a partner who has some equity, if you can set aside a reserve. Like, be creative in how you put together your capital stack, because at the end of the day, lenders are security conscious. that their number one concern is not losing money. Your number one concern is making money. So you have to meet them somewhere in the middle and say, if I can show you that I have proof of funds and I can set aside a reserve, does that make it more feasible for you to make this loan? So.
All right. So we are at 11:20 on the dot. This is time. We'll stay around if anybody has extra questions, but please join me in thanking our panelists. All right. That's it. Thanks, everybody.